In these unpredictable times, making the right business moves is more crucial than ever. Join us as we dive into the world of short-term business decisions to help you stay ahead. So in this series, you'll be able to master the art of evaluating special pricing orders, learn how to maximize revenue and minimize costs, make informed, strategic choices that drive success even in uncertainties. Equip your business with the strategies it needs to thrive in challenging times. We are starting a new series on short-term business decisions. Short-term business decisions. This is part 1 of short-term business decisions. As a disclaimer, the content of this video is designed for educational purposes and aims to enhance your understanding of accounting principles and practices. It should not be considered professional advice. Always consult with a certified accountant or financial advisor for specific guidance tailored to your individual needs and circumstances. The learning objectives of this series: 1 is identify information that is relevant for making short-term decisions. 2, make regular and special pricing decisions. However, in this video of part 1, we will only cover learning objective 1, identify information that is relevant for making short-term decisions. We will continue with learning objective 3, make decisions about dropping a product mix and sales mix. And 4, make outsourcing and processing further decisions. So in learning objective 8.1, which deals with identify information that is relevant for making short-term decisions. In this video, we explore how managers leverage their understanding of cost behavior to make crucial short-term business decisions. Now, these include assessing whether to accept an order with special pricing or deciding to discontinue an unprofitable product. The focus here is on decisions affecting periods typically 1 year or less. We will also discuss long-term decisions, but we will discuss that in the next series. For now, we're going to examine a manager's decision-making process and the vital information needed to evaluate their options. Here you see in Exhibit 8.1, it illustrates how managers choose among various courses of action. First step, define business goals. Identify alternative courses of action. Gather and analyze relevant information. Compare alternatives. Choose the best alternative. Managerial accountants, you play a key role in the 3rd step, which is gather and analyzing relevant information to compare alternatives. When managers make decisions, they zero in on information that is pertinent to those decisions. Now, relevant information is defined as expected future data that varies among different alternatives. Relevant costs are specific to the decision at hand. For instance, if Smart Touch Learning is contemplating purchasing a new delivery truck and they need to choose between 2 different models, several costs become relevant. Now, these costs include, of course, the cost of the truck. They should consider the sales tax and also insurance premiums. Now, these costs are relevant. They're relevant because 1, future costs. These future costs are incurred after deciding which truck to buy. The other is differ among alternatives. Now, each truck model has a different invoice price, sales tax, and insurance premium. These relevant costs directly impact the decision of which truck to purchase. Now, this principle applies universally. Only relevant data and costs should influence decisions. Again, only relevant data and costs should influence decisions. So ignoring irrelevant information helps managers focus on the factors that will truly impact the outcome, leading to more effective and efficient decision-making. In every scenario, identifying and analyzing relevant information ensures that decision-making process is both rational and beneficial to the organization. Now, managers rely on this targeted approach to navigate through various business challenges and opportunities. When making decisions, it is crucial to distinguish between relevant and irrelevant costs and revenues. Irrelevant costs and revenues do not impact the decision because they either are not future-oriented or do not vary among alternatives. Irrelevant costs and revenues, in our truck example, let's consider this. If the two models have similar fuel efficiency and maintenance ratings, we do not expect the operating costs to differ between them. Since these costs are the same for both alternatives, they are irrelevant to Smart Touch Learning's decision. In other words, these costs do not affect the choice between the two trucks. Sunk costs. Sunk costs are expenses that were incurred in the past, and they cannot be altered by any future actions. So as a result, sunk costs are always irrelevant to decision-making. This doesn't mean we can't learn from past decisions. Managers should always consider the outcomes of past actions. We should all. That's just a side note. However, because some costs are already spent, they do not impact future decisions. For example, if Smart Touch Learning wants to trade in its current truck when buying a new one, that $15,000 paid for the current truck a year ago is considered a sunk cost. No current decision can change that past expenditure. The company must now decide whether to keep the current truck, to trade it in, or sell it for the best possible price, even if that price is much lower than the original cost. What matters now is the future value Smart Touch Learning can get for the truck. For instance, if one dealership offers a $8,000 trade-in value while another offers $10,000, now these amounts become relevant because they differ and they pertain to a future transaction. So the $10,000 trade-in value is considered relevant to the decision of where to trade in the truck. When making decisions, managers should consider both financial, quantitative information, and they should also consider non-financial, which we call qualitative information. So non-financial factors, they're often crucial and can be highly relevant to managerial decisions. The importance of qualitative factors are: 1, employee morale. For example, closing a manufacturing plant and laying off employees can significantly damage employee morale. Number 2, control over quality. Outsourcing production can reduce control over delivery times, or it can either impact the quality of the product. And the third is customer relations. Offering discounted prices to select customers might upset regular customers, potentially leading them to take their business elsewhere. Managers must always weigh both the quantitative and qualitative effects of their decisions to avoid significant oversight. A common method for making short-term business decisions is differential analysis. Differential analysis is an approach that focuses on how operating income would change under each decision alternative, excluding irrelevant information. By emphasizing the differences in operating income between alternatives, differential analysis helps managers make informed choices. Now, this method is also known as incremental analysis. Instead of examining the entire income statement for each decision alternative, differential analysis zeroes in on the changes in operating income. Irrelevant information, costs and revenues that remain constant between alternatives, is excluded from this analysis. The key applications in short-term business decisions in this series that we're discussing, we're going to explore also the various types of short-term business decisions, which will include regular and special pricing, dropping unprofitable products and segments, product mix and sales mix, outsourcing, and processing further. So by using differential analysis, managers can effectively evaluate these decisions, focusing only on the factors that impact operating income. This streamlined approach ensures that only the most pertinent information is considered, leading to better decision making. So as we study these decisions, remember the 2 essential principles for analyzing short-term special business decisions. 2 keys in analyzing short-term business decisions are: 1, focus on relevant revenues, costs, and profits. Irrelevant information can obscure the decision-making process and lead to information overload. So you want to concentrate on the data that directly impacts the decision. Number 2, use a contribution margin approach. What is a contribution margin approach? It is a method that separates variable costs from fixed costs, which behave differently and must be analyzed separately. Traditional income statements blend fixed and variable costs, potentially misleading managers. Contribution margins income statements, which categorize costs by behavior, which are your variable or fixed, They provide the necessary cost behavior information. It is also important to note that unit manufacturing costs are mixed costs. They can mislead managers if not properly separated into their fixed and variable components. So, when using manufacturing costs in your analysis, please make sure that you ensure that you first divide the unit cost into its fixed and variable parts. By applying these two key principles in each decision, you can make more informed and accurate business choices. So this is the end of part 1, which we discussed learning objective 1, 8.1. So in the next video, we will start with part 2, which will involve learning objective 2, make regular and special pricing decisions. Thank you for watching, and please do not forget to click the like and subscribe button. And if you have any questions or comments, please leave them below and I will reply to you.